It's no secret that over the past 20 years, investing in property has been one of the most lucrative investments someone can make in order to increase their wealth, and it serves as a great way of diversifying your investment portfolio and reducing your exposure to the stock market. Property prices in the UK have trebled over the same time period, giving a compounded annual growth rate of 5.7%, and the story is much the same over in the US, with a compounded annual growth rate of 5.3%. And when you combine this with potential rental yields of anywhere between 5 and 7%, the total compounded annual return on your investment can be as high as 12%, which is far greater than the compounded annual growth rate of the S&P 500 over the same time period of just 6.5%. And that's without even taking into consideration the power of leverage to your returns, but we'll save that for another day. Now, of course, there are two strong arguments for investors wanting to avoid real estate altogether, with the first one being most people don't want the hassle and stress of being a landlord, and the second being the high upfront capital cost required in the form of a down payment. Both of these arguments make sense, and well, these people make a fair point. But what if there was a way in which you could invest in real estate and own hundreds or even thousands of properties without ever having to make a single down payment, and without having to look after the property at all? Well, that's where REITs, or real estate investment trusts, come into play. A REIT is a company that owns, operates, or finances income-generating real estate. In short, individual investors' money is pooled together to buy real estate with the goal of making profit through both rental yields and capital appreciation. Now, one of the requirements of REITs is that at least 90% of all taxable income must be distributed to shareholders in the form of dividends. So if you're someone that likes the passive cash flow generated from dividend stocks, then you may want to take a closer look at REITs. However, that does mean that because they're paying out so much of these profits to shareholders, they aren't retaining that cash in order to acquire more property. So the growth in these companies tend to be a lot slower. But that shouldn't really be a concern to you as the individual, as you can take those dividends and reinvest them, therefore owning a larger stake in the business and further compounding your growth. But if you're still not convinced that REITs are a solid investment that should be included in every portfolio, just take a look at this chart here, which shows that the returns of REITs over the last 20 years have blown the S&P 500 returns out of the water. But of course, as with any investment, you're going to want to try and pick the winner, and not all REITs are made equal. There are so many different REITs available, from retail REITs, which focus on shopping malls, to residential and office REITs, which focus on, yep, you guessed it, residential housing and office space respectively. Now, for me personally, I'm not investing in office REITs because I genuinely think that COVID has changed the way that we work forever. My firm has already come out and said that they expect that even once all restrictions are lifted, people will choose to spend between 40 and 60% of their time working from home. And I think that a lot of other companies and firms will do the same. So I don't want to invest in an industry that I think could see a continued decline over the long term. And then you've got the housing market, where prices have increased at an unprecedented rate, making it really difficult to find any value in residential REITs. And so for now, I'm avoiding those as well. However, after having analysed a whole bunch of REITs in a variety of different industries, I've picked out two which I think are going to outperform the stock market in the long term. The first REIT on my list is Community Healthcare Trust, ticker symbol CHCT. This REIT focuses on real estate that is leased to hospitals, doctors, and other healthcare service providers, and has therefore positioned itself in an industry which is growing at a surprising rate. The over 65 population in the US is expected to grow by a total of 48% over the next 20 years. And with healthcare not only becoming more advanced, but also becoming more accessible to more and more people, the demand for healthcare space and buildings is only going to increase. The historical financial performance of this company really speaks for itself. Over the last 5 years, revenues have grown by 200%, earnings have grown by 600%, and funds from operations, which is similar to free cash flow but is a better metric to use for REITs, has grown by 200% as well. There are very few REITs that have been putting in growth like that over the last 5 years, and so this is definitely one to look out for. Over the same time period, their share price has seen capital appreciation of 105% on top of the healthy dividend that they are paying out, which currently sits at 3.5%. I expect this REIT to continue to put in strong growth numbers in their financials, so in my opinion, this is one that you should put on your watch list, do your due diligence, and then decide whether this is the REIT for you. But from where I'm standing, I'm not sure that there are too many better REITs than this one out there at the moment. Okay, so the second REIT on my list is Equinix, ticker symbol EQIX. This REIT is the largest provider of colocation data centers in the world, and therefore is driven by the ever-increasing digitalization that we're all witnessing. Some of you will be aware that I think the cloud-based data industry is going to grow to become one of the largest industries in the world, because I honestly think that 20 years from now, there isn't going to be a single company that can operate without the need for cloud computing or data storage of some sort. And therefore I think that data center REITs are an excellent way to take advantage of that growth. According to a research study, the global computing market was estimated at $321 billion in 2019 and is expected to reach over $1 trillion by 2026, growing at a compounded annual growth rate of 18%, putting it as one of the fastest growing industries in the world. However, naturally, being in such a high growing industry does mean that you're going to have to pay a premium for the stock. The REIT is currently trading at a PE ratio of 183, which is ridiculously high no matter which way you cut it. But analysts are forecasting for earnings to grow at a compounded annual growth rate of 40% for the next 5 years, which would bring the forward 2025 PE ratio down to 35. Now that does still feel, in my opinion, a ridiculously pricey valuation. But if you do want exposure to the fastest growing industries and the market leaders in those industries, you are going to have to pay a premium for that. And Equinix has positioned itself to continue to be the market leader into the future by developing network dense locations in major cities, which make it extremely difficult for competitors to replicate. Despite its large size with a market capitalization of over $75 billion, over the past 5 years, Equinix has grown revenues by 66%, earnings by 192%, and funds from operations at 98%, demonstrating not only good growth but also increased efficiencies in their operations through margin expansion. This has led to capital appreciation in the stock of 121% over the same time period, and a current dividend yield of 1.4%, which I expect will increase significantly over time. Because it is pricey though, and it has increased by over 40% in the last 4 months, I do think that we could see a reasonable pullback in the short term. My approach with this one would be to purchase around 25% of my total allocation for the stock, and then continue to monitor the price action over the next 3 months or so, adding to my position on any significant dips. What I can't stress enough with this one though is that this is not a short-term hold. And by short-term hold, I mean 1 to 2 years, not even 1 to 2 months. Over that time, the price of this could easily fall significantly. And when I say significantly, I mean a 30 or a 40% pullback. But over the long term, say 5 years or more, I do think that this will outperform the S&P 500. Anyway guys, these are the 2 REITs that are currently on my watch list. I don't have a position in any of them yet, but I am going to do a little bit more due diligence and then open a position if I feel it is right to do so. Comment down below with what your opinions are on REITs and whether you have any in your portfolio. Just remember that all of this is just my opinion. It is not financial advice and it should not be construed as such. But until next time guys, thank you.